Hello, Yevon.
Hello?
Hello, can you hear me?
Okay, can you hear me?
Yeah, you're audible,
Okay,
Crystal.
nice.
Great. So, first, I'm going to introduce you to the audience, and then you can deliver your talks. All right. Hello, everyone. Good day, and welcome to session 4 for day 2 of PyCon Indonesia 2020. My name is Zaki, and I will be the moderator for this session, Python for Finance, Markowitz Portfolio Optimization by Yevonnael Andrew. Yevon is an interdisciplinary science researcher who applies machine learning to solve problems. He is also an investor that is using quantitative finance techniques to create a better investment decision and a data science mentor at Supertype. In this talk, he will first review the basic theory of quantitative finance, then we will discuss how to use Python to analyze financial data and demonstrate how to create an optimal portfolio using Markowitz theory. Okay, I'm going to share your screen now.
Okay, perfect.
Okay, okay.
Okay, can you see my PowerPoint?
Yeah, I can see the presentation. Then, without further ado, the stage is yours, Yvonne. For participants, you can keep those questions coming on Hopin platform, and the moderator's team will collect them and we will discuss it in Q&A session. Let's give a big round of virtual applause to Yevonnael Andrew.
Okay, thank you. Okay, can I start my presentation? Okay,
Sure, go ahead.
welcome everyone. Welcome to my talk, Python for Finance. My name is Yevonnael Andrew, and I will give a bit of my background first. Okay, before I jump into the introduction, there is some caveat in this presentation. This presentation content is not investment advice, and our presentation only provides a textbook approach. So there will be a lot of simplification of the concept. The presentation is intended to spark interest in the audience side. So I hope after you listen to my presentation, you have an interest to study further. Also, quantitative finance is mathematically rigorous. It's not only about copy and modify some code and then Viola, you are a quantitative finance. No, you really need to study math deeply. Okay, first, my background. I got my bachelor in civil engineering, and I do my second bachelor on medical physics simultaneously with the Master of Science in AI and ML. My interest is in the intersection of statistical physics and the implementation of machine learning and AI in the physics, and also the philosophy of physics. Also, my interest is in the interdisciplinary area, like physics to finance. Okay, now you may have a question. What the heck? Physics and finance, what's the correlation? Okay, after you listen to my presentation, I hope you will understand how physics and finance is correlated. First, uh, there's a lot of financial physics book on the internet that you can learn. Basically, this book is teaching you about how to apply the physics concept to the finance market. I quote a definition from Wikipedia. There is a term called Econophysics. It's an interdisciplinary research field that applied uh, method and theory that developed by physicists to solve problems in the economics. Why? Because in nature, our world, the universe, is really random. So the physicist thinking, okay, because our universe is random and because stock market is random, why not we apply the physics theory to the finance? And this is the born of the born of a field called quantitative finance. financial in the past, like on the picture on the left, is where the people want is when the people want to buy a stock, they should go to the exchange office and they should uh, queue from the morning and shout each other to buy the stocks. In the present, like I put the image on the right side, there is an application in Indonesia called Bibit. It's a mutual fund investment application that use a robo advisor. So what is robo advisor? Robot advisor basically is a technology that based on modern portfolio by the Markowitz. You can see the definition here. Yeah, the Markowitz that I will explain to you today. And then what will the future look like for the finance? Here I post some TED Talk. The title is How AI Trader Will Dominate Hedge Fund Industry. And this also explain how robo-advisor offer a hassle-free investing and greatly reduce costs. So in the future, we we don't we will we won't see a traditional trader or traditional investor. They will be replaced by AI and machine learning. So this is why important to you if you really interested in the field to enter the field as early as possible. This is also a news that I quote from Business Insider. There is a job title called quants. It's a slang or a short of quantitative finance. The math genius running Wall Street. So if you read the news, it is a news that I quote. I quote some text from the news. Around 70% order of buy and sell on Wall Street now placed by software program. And the program is built by studious looking people, mathematical genius who are responsible for writing this program. Okay. And you can see the PhD in finance need not apply. Yeah, it's maybe a bit extreme. But basically he said, if you don't understand the math, if you don't understand the coding part or computer science part, don't apply to here. Because in this era, we need people who can code the mathematical formula to do the trading. Okay. This is the example of quantitative finance job and the skill that you need. So basically, like I said, it's using mathematical framework and you need a rigorous mathematical skill. So you need programming, algorithm, statistics, calculus, linear algebra, financial theory, economy, etc. But luckily, if you already have an undergraduate degree from STEM background, like computer science, statistics, mathematics, you already have the basic. You just need to learn the economics theory and maybe like financial modeling and econometrics. You can self-learn or maybe you can go for an advanced degree. Okay, now we go to the history. The history first began with Louis Bachelard, wrote a doctoral thesis with the title Theory of Speculation. It provides a model to price options under a normal distribution. And then later, Harry Markowitz wrote a doctoral thesis called Portfolio Selection, and he introduced the concept of diversification that used the notion of mean and covariance. Okay, and then later on, and pay attention to this year, Emmanuel Derman wrote the book My Life as a Quant: Reflection on Physics and Finance, and he popularized the abbreviation of quant. So quant or quantitative finance is really invented quote-unquote invented by physicists. The area of quantitative finance is broadly ranged from developer pricing model, high frequency trading, risk management, and portfolio management. In this today demo, I will give you a demo about portfolio management to give you a bit how to taste how to be a quantitative finance. Okay, but remember the caveat: this is a lot of simplification and textbook approach, so it may not be a best approach to make a investment decision. But definitely, you can start from here and do some self-learn and go investment. Okay. The concept diversification, we know it as do not put all your egg in one basket. So the primary goal is not increase the profit, but to reduce the risk and for the buffer of volatility and mitigate the losses. Okay. Here I give you a scenario. If we have $10,000 and we have option to invest in 5 different company, which company you will invest? And how many percentage in each stock we will invest? Do you will invest 100% of your money in the company that give the highest historical return? Well, if you newbie to the stock market, you may do it. You may do this kind of approach. You see, oh, this stock give the highest historical return, and I will put all of my money in here. And you lose money, and you blame stock market as a scam. Or maybe you have a better approach. Distribute evenly. So if you have 5 stock, you will divide your money evenly, 20% in each stock. Or you distribute according to the market cap. To the market cap, basically, you put your money with higher percentage in company that have a higher market cap and lower money on the company that have a lower market cap. Or you will create an optimized portfolio, which is our goal for today's session. Before I go to the demo, the coding demo, I will explain the basic of optimized portfolio. So, the optimized portfolio is based on modern portfolio theory. If you read the textbook or you have a degree in finance, you may know this mean variance. Or if you have a degree in statistics, this is a very familiar term for you, mean variance. It is developed by Harry Markowitz, and because of this theory, Markowitz awarded a Nobel Prize in economics. Okay, so what does it mean? It signifies the importance of this method. If this method is not important or just not really significant, the Nobel Prize Committee, of course, will not give the Nobel Prize. Okay. In the modern portfolio theory, we will quantify the return and risk ratio by using a CRP ratio as a metric. Okay. The CRP ratio formula is the return of portfolio minus return of free risk divided by standard deviation of the portfolio. Okay. The CRP ratio gives a better return for the same risk. So if we have two portfolio, they have a same risk, equal risk, and portfolio one have a better return. Of course, we won't pick this portfolio. And if we calculate the CRP ratio, this portfolio will have a higher CRP ratio than this portfolio. Okay, so our goal is to pick a portfolio that has a higher CRP ratio as possible. Okay, and then we have a lot alternative to the CRP ratio, and we have an extension to the original method like postmodern portfolio theory, Black-Litterman model, and everything, etc. But the Markowitz theory is the textbook approach. Of course, you will learn it anywhere. So we will start from here. This is the calculation example using Excel. So if imagine now imagine if we have two stocks, two assets, X and Y. The return of asset X is 8% and the return of asset Y is 10%. And the volatility is 14% and 10% respectively. Okay. By combining two assets, we automatically reduce our risk to the volatility. Okay. Let's see. If we have only stock Y, our volatility is 10%. If we only invest 100% in stock X, our volatility is 14%. But if we combine this stock, the combination will produce a lower volatility. You can see even this volatility, even this combination, the number 3, the volatility is lower than a single stock. So if you want to invest in stock market, by diversifying your money to the at least 2 stocks, you already decrease your volatility or you already decrease your risk. And this is the formula. Yeah, it's not really important for today. From the calculation, we can plot the return and volatility plot. Okay. And from this volatility, we have a line. This line we call efficient frontier. Okay, I will explain it. So the result of our optimization using Python, this is the result. Okay, this is an individual stock. The a bit transparent one is the individual stock. And we have 2 lines that a bit bold. The red line is if we invest our money evenly in each stock. So if we have $100, we distribute evenly in this stock. And if we do that, this is our return. But if we optimize using Python, using Markowitz theory with Python, you will have a better portfolio. Okay? But this is only historical. We only use historic data to calculate the composition, and we using historical data to analyze. But we want to simulate our return for the future, right? To simulate, we will use a stochastic model, or maybe you familiar with the terms Brownian motion or Monte Carlo. Yeah, it's similar. So the stochastic model is dst return plus sigma lambda stdt, etc., etc. So this stochastic model is introduced by Louis Batchelor, and later Albert Einstein rediscovered this formula independently, and he used it in the field of physics. Okay. So, and then we have the standard Brownian motion here. If you can see the formula in the right side, this is the random part of our return. So this is the deterministic one, and this is the random part. The random part is follow a Gaussian distribution. Okay. Okay. I want to explain. So this is this result of simulation using Python. Okay. Now we go to the demo. For the demo, the library that we will use is FinQuant, NumPy, Python, Pandas, PyFolio, and Matplotlib. It's a standard. For the FinQuant, you can do a quick search on Google, and you can install the package, and you can start to trial. You can start experimenting with the code. Okay, now let's go to the demo. Okay, this is the code that I will use. So the first step is to import all the library needed. Okay. After we import the library, we specify the name of stock that we interested in. Okay. So I pick 5 stock from Indonesian market and 5 stock from US market. In reality, the stock picking is also have a special discussion. It's not as easy as I want this, I want this, I want this. No, you should compare the correlation and the covariance between returns. The covariance between returns can be, you can see here. This is the correlation and the covariance of the stock. So basically, in general, we want to choose a stock that has a low correlation between that stock. So when one stock is go up and one stock go down, they can buffer each other. And in general, our trend is up, hopefully. After we specify the stock that we want to analyze, we specify the start date, the end date, and we use a function build portfolio from the FinQuant. Yeah. The data we will use is from Yahoo Finance. You can also use data from, let's say, QuantL or maybe Never, Sina.com. It's your choice. But Yahoo Finance provide us a free stocks data. You can immediately use that. We will run it. Okay. Now the function will fetch the data from the internet. Let's wait for a moment. Okay. See, it's completed. Now we can see the data. It's basic Python function. And we now want to calculate the return of each stock. So it is the price of each stock. Now we want to calculate the return. We can use percentage change to calculate the return. Oh, of course, you should drop NA to make sure no NA value. Make sure no NA value, but drop NA may not the best approach. Okay, and not the best approach, but for simplicity, I will just drop. And then we will create a portfolio with equal weight. Yeah, it's basic mathematics. So we will divide according how many stock we have. And if we see the data, it will return like this. Okay. So it's a cumulative return equal of our portfolio. And we can plot our equal weight portfolio. Okay. This is like the previous plot in the presentation. This red line is performance of our equal weight portfolio. So this is the this portfolio consists of this stock, and we can see the properties. You can see, like I said, we distribute evenly our money, And we have expected return portfolio for 16% and the volatility 14% and the Sharpe ratio 1.172. And we copy it because we will use it later. Equal weight. Okay. Now, because we want a smarter approach, we will see a combination of the weight in our portfolio. Of course, we can, let's say, we can put our money 30% on the BBCA and 30% in the BBNI, and the rest we put all in the Tesla. It's possible. So we will use a brute force approach using Monte Carlo. So we will create a simulation. How? So we will create a 10,000 combination of portfolio weight, and we plot them in one plot to see the performance. Yeah. This is the result of our Monte Carlo brute force simulation. We can see this is the individual stock, the return and the volatility of individual stock. Let's interpret what. Let's say we choose Tesla. In here, Tesla have a volatility about 45%, and the return is about 20%. Okay, so Tesla have return 20% and the volatility about 45%. Now we also have, let's say, BBCA. BBCA has a return about 20% too, roughly the same, and the volatility is about 20% too. Which one you will choose? Of course, as a smart investor, you will choose this for your investment. Why? Because it offers the same return for a lower volatility. Okay, and of course, we want to buy, let's say, this Antam. Of course, we won't buy an Antam stock. Why? Because they only has a return about 10%, and the volatility as high as 43%. Of course, you want to avoid these stocks. Okay. So this is basically how to interpret the plot. And this is the combination of our plot that has a best result. Best result in terms of the maximum Sharpe. I will add a note here. Best result max Sharpe. Okay. Well, in reality, it's a bit complicated. Okay, but for the demonstration purpose, we will use the max Sharpe ratio. So the maximum Sharpe ratio, we have this, the X with red color. The max Sharpe ratio is we have 25% return, and the volatility is very low, about 14%. Well, of course, as an investor, you will choose this portfolio, right? Because they offer a high return, even higher than BBCA or even higher than Tesla, but the volatility is very, very, very low. You see? So this is our goal to create this kind of portfolio. But the question now, what is the percentage of each stock, right? How to create a combination of stock that can produce, how to create a combination that produce the portfolio with 25% return and volatility 10%. Luckily, the function, the library provides a simple function. We can extract the weight that produce the max Sharpe ratio. The extract. Okay. So the weight in our portfolio that produce this portfolio with this metric is if we invest our money about 36% in the BBCA and 12% in Indofood, ICBP, 35% in Microsoft, and 15% in JP Morgan. Okay, so this is the way that will give you a good result in your portfolio, which have a maximum Sharpe. Now we want to recalculate the portfolio performance if we invest our money with this way, this optimal way. Okay. Now we will input the optimum weight to the variable and we calculate just like before. It's not different. Now we plot. Okay. See? The red one is if we invest in equally way. And the blue line, if we invest in this way. Okay, I will copy the weight. This weight, optimal weight portfolio, produce, let's see. Okay. Produce this. Let's see. I will delete this. Now, let us compare the equal weight and the optimal weight portfolio. You have a higher return, 7% higher, and you have roughly the same volatility, and you have a higher Sharpe ratio. Okay, so with the same volatility, you can have a greater return. Higher. Isn't it nice? Yes, of course. So we have a higher Sharpe ratio. So this is our matrix, like I said before. Now, the problem here is we use historical data to create a weight, and we use the same historical data to calculate, right? We can test the performance of our portfolio by two methods. In general, we have two methods to test your portfolio. You divide your data to train and test set. So you optimum weight from train and then simulate in the test set. This is one way. The second way, we can use simulation, Monte Carlo simulation. This is the function of Monte Carlo simulation. It's like what I stated before. So basically, we will translate this formula to the code. Okay, this is the code. And now we specify how many years we want to forecast. Let's say we will forecast 5 years ahead, and we will have maybe 10 scenario, and the mu 23, okay, and the sigma is okay. And how many steps a year? Okay, let's say use 100. And we will put our simulation. Okay, this is our simulation. So let's interpret the plot. For 5 years ahead, with 10 scenario and the specified mu and sigma, we will yield this result in our portfolio. Okay, so this is one scenario, two scenario, scenario 3, scenario 4, etc. Because it's random, we cannot really sure how the portfolio will perform in the future. So I will pull the mean and median and I will plot. Of course, you can do statistical summary like confidence interval, or maybe you can use value at risk, something like that. You can do, and you can analyze your portfolio performance in the future. That's two. Okay, basically the demo is over, but maybe some of you already get interest to study this subject. How to study? First, my recommendation is if you already have a degree in STEM major, science, technology, engineering, or mathematics, you can supplement your study by self-learning with these free resources from MIT or CW. The two topics that I really very recommend to you guys is this one topic in mathematics with application in finance and finance theory. Okay, you can use it to study. Basically, it's free, but of course, you won't get a certificate. Certificate is useless. Okay, don't chase for certificate. And then, when selecting a material to study from, please be aware of someone who claims to be a guru or expert. Someone who promise you can be a quantitative finance only 1 month. It's nonsense. Okay. So please prioritize a more credible source like EDX, Coursera, textbook, and the others. And this is my recommended book. Maybe you can start from the middle one, Python for Finance. It's but it lack of mathematical understanding about how this financial data works. And for the mathematical understanding, you can choose either one. Okay. Anybody have a question? You can reach for me in LinkedIn if you have a further discussion. And I do not offer investment advice. Thank you.
Okay, thank you so much for the amazing talk, Yvonne, that you have shared with us. It certainly opens a new perspective for us, and for me personally, I learned how to formulate the modern portfolio Markowitz theory using the Python, and also forecast which company will give us the best return. Is that right?
Yeah.
Okay, so we've already got two questions. The first is from Jatmiko. Have you tried your method to support your decision to buy stocks in real market, and how's the result?
Okay. Like I said before, uh, the one that I present is not my method actually. It's a textbook approach. That's the method that you will learn when you involve in this kind of field. But I believe with a more deeper understanding about the subject, you can create a better decision in your investment. And yes, I use this kind of things uh, to support my decision in the stock market. But I don't use the simplistic approach that I present here. I use a bit, uh, not advanced, yeah, a bit advanced method. But of course, you can study and you can analyze the stock to support your decision. And about the result, I okay. My comparison is to the like IHSG. If the comparison is made to the IHSG, yes, I have a better results. Okay.
Okay. So that's the first question. And the second question is also from Fahim Jatmiko. I think it's a follow-up question. What are the drawbacks or what should be improved from your experiments?
Okay. Yeah, it's a very good question. The most crucial part that you should improve from the existing code is to create a test set. Okay, because I use the historical data entirely to analyze, and I use the result from historical data to create a plot like this. Okay, so if you ask me what should be improved, of course, try to divide the data into two parts: the trend data and the test data. And from that, you can really see how your portfolio will perform in unseen data. That's one. And the second is for portfolio management, you should try to pick a stock. Okay, you should try to deploy a more sophisticated or more advanced stock picking mechanism. Because what I do here is I pick the stock randomly, right? I
Mhm.
didn't say, oh, I want to choose two from this sector, two from that sector, or maybe another two. Maybe for the Muslim, I want a Sharia stocks, or you can have many, many other options. And from that, you can choose a stock picking method to pick the stock to be put in your portfolio. Yeah, so that's what should be improved.
Okay, so and it's a follow-up question for me. And is there like a mechanism, program mechanism to choose the company so we don't choose the company randomly, as you said previously, as the drawbacks of your experiments?
Oh yeah, of course. There's even one thick book that teach
Oh.
us how to pick the stock. Okay.
Mm.
Basically, you can pick a stock, let's say, from a different sector, or
Mm-hmm.
you can pick a company that has maybe a higher debt equity ratio, or you can read the financial report. Yeah, you can deploy or employ many others. Yeah, you can employ many methods that are available, or you can invest. Let's say you want to invest in an emerging market, or you want to invest in China company. It should all included in your consideration. This is the another notebook that I create for simple explanation, because I expect this question is Rose. So from the returns, we
Mm-hmm.
create the correlation of the return. You see? So this is the correlation of the return. So the return of BBCA correlate with 35% of return of BBNI, right? And you can create covariance. Covariance is okay. You can also use covariance matrix. The basic principle is you want to choose a stock that have a low correlation. Yeah, so that's the basic principle, and you can try to improve from that.
Okay, so that's really a cool thing on how we can choose the different company that has low correlation so that they can is complement correct word for it. So when the other one is going down, the other one going
Yeah,
up,
yeah.
so they can complement each other.
It's like buffer.
Oh, it's a buffer. Okay.
Yeah.
And oh, it's 16:36 already. So I'm sorry, unfortunately we ran out of session.
Okay.
What an awesome session that we had today. We learned about
Okay.
Markowitz.
Maybe
Mhm.
how many minutes we have?
It's time up actually. We
Okay.
should
Okay.
be
Okay.
finished on 16:36. Or maybe
Okay. Okay.
you want to wrap it up for the last time, like closing statements.
Okay. So the closing statement is, if you have any question, a basic question about finance and Python, you can reach me on LinkedIn. I will try to answer as best as I can, and I will try to. Maybe you want to ask for book or course that recommended, but one thing I do not give investment advice. Okay,
Okay.
that's it.
Okay, thank you so much for the talk. What an awesome session. And also for the audience who participate in this session, thank you very much. Allow me to close this session. And what a great 2 days in PyCon Indonesia. And we hope to see you again, including you, Yevon, in PyCon 2021 with another interesting topic.
Thank you. Thank you, everyone.
Okay, thank you, everyone. Goodbye. See
Goodbye.
ya.